All right. The next exercise we're going to do is brief exercise 22-12. Now you'll notice that we're skipping over some of them, and those are IFRS exercises. And IFRS has a few options in it, and I'm not going to test you on that in this semester. So you won't have to worry about the IFRS information on this particular class. But so we're going to go to 22-12 and then 22-13. It'll basically be kind of a repeat of what we did in, I think it was 5 and 6, where you'll do the direct method and then the indirect method with the same information. Now, what would be ideal here, and I would hate to admit it, but I'm probably one of the worst at doing it this way. But what would be ideal here is if you stop this now and attempted 22-12 on your own, having seen 22-5 earlier, or 22-6. Yeah, 22-5. Yeah, having already gone through 22-5, go ahead and try to do 22-12 on your own, then come back to this video and see how you do. That would be the ideal way to do this. But anyway, so assuming that you've either done that or you've decided not to do that, we're going to look at this. And again, we're given a comparative balance sheet for the end of, or the beginning of the year, the end of the year, and then the income statement for the year. And so the first thing that we need to do on all this is to get the cash collected from customers. And so we start that process with the sales. And our sales for this period was $137,710. Okay. And then next up, we increase or decrease the accounts receivable. So at the beginning, there was $50,000 in accounts receivable, and at the end of the year, there is $30,000 in accounts receivable. So that means we collected $20,000 more than we actually sold this year. So we're going to add the decrease. That's right, add the decrease in accounts receivable. And that's going to be the $20,000. Add that up. And our cash collected from customers is $157,710. So now we come up here, cash collected from customers. And that was $157,710. Okay, great. All right, the next thing we have to worry about is the merchandise. Okay, so we start with the merchandise with the cost of goods sold. That comes off of our income statement. And cost of goods sold was $82,626. All right, then we're going to make the adjustment for inventory. So now we're going to go to our balance sheet, and merchandise inventory was $41,200 at the beginning of the year, but is $18,900 at the end of the year. And so we sold off inventory, right? And so the decrease in inventory is $22,300. All right, then we have our purchases. That's so that's the net of that, and so with our purchases, Let's see, subtract the 22,300, that gives us 60,326. Okay, now we have to make the adjustment for the accounts payable. That's going to come from the balance sheet. And accounts payable started at 19, became 21. And so we paid 2,000 less. So we have an increase in accounts payable. All right. Okay, so I subtract that off of there and I get 58,326. And that will go up there, cash paid for merchandise. $58,326, and of course that is a negative. All right, the next one comes from cash paid to other suppliers. We've got selling, general, and administrative expenses. And that is 23,584. There. Then we have prepaid expenses. And the one that we have there is the prepaid rent. And we went from 1,800 to 10,100. And so that the difference there is 8,300. Okay, then we have a decrease in accrued expenses from 21,500 to 1,700. So the difference is 4,500. And we add that all up. And we should get 36,384 on that one. So then I bring that back up. Cash to paid to other suppliers. And that's the 36,384. Next, I'm going to have the cash paid for interest. That's going to be the interest expense on the income statement. And that looks like $6,000. Next up will be the investment income. I don't see any on this particular income statement. So investment income is 0. And then finally, we have our cash paid for taxes. So our taxes, we start with the income tax expense of $7,000. right? And then we look at the liabilities, income taxes payable. It was 16,750, is now 15,750. So we paid an extra $1,000. So we have a decrease in taxes payable of 1,000. So we paid 8,000 for taxes. And if we add that all up, we should come out to should come out to 49,000 on that. So that's cash from operating activities. So there is an example of a direct method, and that is exercise 22-12.